Most people agree that dollar cost averaging is one of the best strategies to invest. Market up, you buy. Market down, you cry a bit, then you buy more. But is there actually a correct way or wrong way to DCA? To find out, I ran over 10,000 DCA simulations across 6 markets, and the results actually surprised me. In this video, I will answer how often should you DCA, whether DCA is actually as safe as everyone says, and whether are there any smarter strategies that can beat DCA. Let's not waste any time and let's jump right in. Alright, let's start with the first question. How often should you DCA? To test this, I compared 5 DCA frequencies on the S&P 500 from daily, weekly, monthly, quarterly, all the way to annual, all on the $12,000 annual budget. And here's the results. At just 1 year, the lines look almost identical. This makes sense because the period is just too short for anything to magically compound yet. But what if we zoom all the way out to 10 years? There's still not much difference there because all the strategies still land within a few $100s of each other. Likewise, even at 50 years, all the strategies end up at virtually the same number on a nearly $1 million portfolio. In fact, this holds whether you are looking at the MSCI World, the UK's FTSE 100, Singapore's STI Index, Japan's Nikkei Index, and the Hang Seng Index. But when you put it all together, you will notice that there's one DCA frequency that almost always wins, and that is annual. That's because when you use the annual DCA strategy, you immediately be investing all the money on the first trading day of every year. And over the long term, markets tend to go up more than they go down. So the earlier your money is invested, the earlier it can compound. And yes, just in case you are wondering, the annual DCA strategy is actually the lump sum investing strategy. On the other hand, if you use the daily DCA strategy, where you slowly deploy your money across every trading day in the year, most of your cash will be sitting on the sidelines and missing out on the potential gains while waiting to be deployed. But what if we remove the annual DCA and just compare the remaining DCA frequencies? In that case, the quarterly DCA would win. But the reason is still the same. With the quarterly DCA strategy, instead of slowly deploying your money into the markets, you are putting in a larger chunk every 3 months. More money goes in earlier, so more of it gets to compound earlier. In other words, over the long term, the best DCA strategy is always whichever one that puts the most money in the market earliest. Speaking of DCA, it has been over a year since I started doing weekly dollar cost averaging through the moomoo regular savings plan. And so far, I'm up by about 19%. What I like about moomoo is how easy it is to discover and research investments. For example, you can head over to the Markets tab, go into US, ETFs, and you'll be able to browse through different ETFs and analyze them directly within the app. Additionally, with the ETF Compare tool, you can also compare between ETFs to see what the differences are between their performance, expense ratios, holdings, and so on. Once you have decided what you want to invest in, you can just open it, tap on the 3 dots at the bottom right, and select RSP. You can start with as low as $5 and enjoy 0 commission for US trading. From there, you can set your investment amount and frequency and even choose to debit funds directly from your bank account, so everything runs automatically. New users who sign up to moomoo SG will get to earn up to $1,200 worth of welcome rewards when you fulfill the terms and conditions, which includes a $100 worth of Nvidia shares exclusively for my channel. Plus, enjoy 0 commission for US, Hong Kong, and Singapore stock trading. Simply follow the steps here and key in my promo code to get your exclusive reward. For more details of the promotions, do refer to the link promotion page in the description below. But then, let's say you suddenly receive a 50k bonus. Is it actually a good idea to invest everything all at once? To answer that, I look at every 12-month rolling window in the S&P 500 going back to 1970s and compare what would happen if you invested everything on day 1 versus DCAing it in every month. And the result? Lump sum investing wins in 69% of those windows. That means lump sum investing came out ahead more than 2/3 of the time. That makes sense. The S&P 500 has had positive annual returns in roughly 73% of years since 1928. So if the market is likely to be higher 12 months from now, the earlier you invest your money, the better your returns. The only exception is during a major crash. That's because when the market is falling, DCA lets you keep buying all the way down, where you are buying the dip of the dip, of the DPT dip. So your average cost always ends up much lower than someone who puts everything in at the top. This finding largely holds for the MSCI World and FTSE 100, where lump sum still comes out ahead in the majority of windows. As for the STI, Hang Seng and Nikkei, the win rate drops to just above 50%. Why? That's because these markets spent years going nowhere. For example, the Nikkei index peaked in December 1989 and didn't recover until 2024. That's a full 35 years of going nowhere. Meanwhile, the STI and Hang Seng Index also saw similar prolonged flat periods. What this tells us is that your investing time horizon matters. If you're investing for the long term, lump sum wins more often because you have enough time to ride out any potential crashes along the way. But if you are just investing over a short window, it's basically 50-50. So if lump sum investing is a superior strategy, why do most people still use dollar cost averaging? Interestingly, in one study, it was found that from 2000 to 2020, the S&P 500 returned 7.5%, while the average investor earned just 2.9% a year over 20 years over the same period. That huge gap was driven almost entirely by panic selling at the wrong time. So even though lump sum investing in theory can give you better overall returns, if going all in means you will panic sell every time a market crash comes, none of that matters anymore. In that case, DCA is the better strategy emotionally, as it lets you stay calmer when markets get rough. Check this out. If you lump sum your money in and invest for just one day, there's almost a 50% chance that you will lose money. But if held for a year, that risk would come down. At 10 years, it's nearly zero. And 20 years, every single rolling period in the S&P 500 history ended positive. The same idea largely holds true whether you are looking at MSCI World or STI or Hang Seng. Now, let's see what happens when you DCA your money over a 1-year period. This time, the loss probability is already lower than going all in on any random day. The longer you keep DCAing, the lower that risk gets. By the time you hit 20 years of DCA, it reaches zero. Not only that, DCA also helps you break even after a crash much faster too. For example, if you had lump sum into the S&P 500 right at March 2000, you would have taken about 13 years to break even. But if you had just DCA through that same period where you buy every month all the way down, you would have broken even 2 years earlier. That's because by buying as prices fell, you are constantly lowering your average cost. This means you won't even have to wait for the market to fully recover before you are back in profit. What this tells us is that DCA is not a wealth maximizer strategy. Instead, it is also a risk reduction tool. One that not only lowers your chance of losing money, but also gets you back to break even much faster when crashes do happen. Now, we know that lump sum wins more often, while DCA helps to reduce losses. The question is there a smarter version of DCA that captures those risk benefits without giving up as much upside? So I tested the simple DCA strategy across 3 other strategies. The first one is called value averaging, which was first introduced in 1993. In this strategy, you set a growth target for your portfolio each month. If you are behind targets because the market dropped, you invest more. But if you're ahead because the market went up, you invest nothing. The idea is to buy more when cheap and hold back when expensive. The second strategy is called buy the dip. So instead of investing every month, you only deploy when the market has dropped at least 10% from its recent peak. The third strategy is called moving average DCA, which was popularized by Matt Faber in a 2007 paper. With this strategy, you only invest when the market is below its 12-month moving average. But when it's above, you hold cash instead. And here are the results. From 2016 to 2025, the plain DCA strategy came out on top, whereas moving average DCA came in last. Then if you look at longer periods, whether it is 20 years or 50 years, plain DCA still won. This is the same for MSCI World, where over the long term, plain DCA would win consistently. However, when it comes to some other markets, things look a little different. For the FTSE 100, STI and the Hang Seng Index, value averaging is the better DCA strategy. In fact, with the Hang Seng Index, value averaging produced much higher returns as compared to all the other strategies. Now, the reason plain DCA wasn't the best strategy for these 4 indexes was because all 4 of them went through prolonged periods of flat or falling prices. When the market keeps going nowhere or crashing back down, strategies that buy more aggressively on the way down, like value averaging and buy the dip, would end up with a much lower average cost. Then, as the market eventually recovers, they would come out ahead. So what does all this mean for you? Every day, we often see people ask whether now is a good time to buy or whether they should wait for a crash that may or may not come. But after running over 10,000 simulations, the data clearly shows that all those clever timing strategies almost never beats a plain DCA strategy, especially in a market that rises over time. This is also the reason why 90% of active funds underperform their benchmark over 15 years. The people trying to outsmart the market almost always lose to the people who just keep investing consistently. So stop overthinking the how. Whether you invest monthly, weekly, or even daily barely makes a difference. What matters is you invest consistently and just leave it alone. Because at the end of the day, the investor who keeps showing up every month throughout the crashes and the rallies will almost always beat the guy who is still trying to find the perfect time to invest. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.